Hello, everybody. Welcome. We're just going to wait a minute or so for everyone to get into the room.
Hi, everyone. I'm going to open up my attendance list and see who's there. Say hello to some friends. Oh, I see my Monrovia friends. Hi, Buffy. Let's see who else.
Okay, I think we can go ahead and get started. So hello, everyone, and welcome to our next webinar in Back to Basics series, GASB Updates 102, 103, 104, with projects What's Coming. We're happy to have you here with us today. Before I introduce our presenters, a few housekeeping items. This webinar is being recorded, so be on the lookout later today for an email containing a link to the recording, as well as a copy of the slides and other resources. This webinar will run 50 minutes with a 10-minute Q&A immediately following. If you have any questions for our speakers, please put them in the Q&A box located in the Zoom toolbar. To find that, hover your mouse over the top or bottom of your screen and a toolbar will pop up. This webinar is eligible for 1 hour of CPE credit. We will launch 4 polls throughout the presentation. To receive credit, you must answer 3 of the 4 polls and also complete the short evaluation you will receive afterwards. LSL is using a new CPE system, so please note that the evaluation email will be coming from LC Vista. Please allow up to 1 week to receive this email. If you're having trouble seeing the polls, try minimizing the Zoom screen as sometimes the poll question box pops up behind it. You may need to click and drag your Zoom screen around a little bit to see it. If you're using multiple screens, check each one as it may pop up on another screen. If that does not work, you may need to disable your pop-up blocker. Now I'd like to introduce our presenters. Kelly Telford is a partner in LSL's Consulting and Advisory Department, bringing over 20 years of experience working in and with government agencies. Her background as previous Director of Finance for city and county agencies gives her unique insight and specialized expertise in accounting and auditing, financial forecasting, and budget development, along with investment and grant management. Jayme Lambert is a senior manager in LSL's Assurance and Advisory Department with extensive experience leading audit engagements for local government agencies, including cities, counties, and utility districts. He oversees all stages of the audit cycle, from planning and risk assessment to fieldwork and financial reporting, ensuring every project meets high standards for compliance and accuracy. Okay, Kelly and Jayme, take it away.
Thank you so much. I feel like looking at this slide, Jayme and I have a little bit of imposter syndrome happening because we look so different today than these slides. We'll have to give marketing some new photos for us. Jayme looks a little younger, and I'm not a blonde anymore. But you guys know us. You guys have all seen us. All right, I'm trying to navigate. There we go. So as Rachel mentioned, we're going to be going through a GASB update today. What you will see missing on this list is GASB 101. We just did a recent webinar, which I'll give you the info for in just a moment. But I am going to touch on it for just a minute because there's been a couple of recent developments I want to bring you up to speed on. We'll be going through 102 for certain risk disclosures. Jayme will present that. I'll be going a little bit more in depth to get into GASB 103 for the new financial reporting model. And then Jayme will jump into 104, and then we'll be going through some projects that GASB has on their list. If we could launch the first polling question, does your agency historically early implement GASB pronouncements? I can kind of guess where this is going to go on the polls. While y'all are answering the question, I'm going to move to one of the slides that we like to present anytime we're doing a GASB update. I like to give you all the dates. We do have agencies from all over the country on this webinar. And while California tends to be I'd say probably 90% of California local governments are a 6/30 year end. We even have some California agencies that are September and December year ends. So this is a list of when all of the current GASBs are effective for you, depending on your year end date. This will be in the slides that you'll receive. So let me touch for just a moment on GASB 101. This is the new GASB for compensated absences. We didn't want to do a deep dive because there was a recent Back to Basics that covered the compensated absences piece. We've included the QR code and the link here for you to go back and be able to view that webinar if you would like to see it. It is accessible on our website, as are all of our webinars. But what I do want to point out, I sit on the Professional Standards Committee for CSMFO. We've got a great group on that committee of both local government folks and folks like LSL from different kinds of organizations. And one of the things that we like to do in that group is talk about what's happening in local government, what questions local governments are having, and how can we help to answer those questions. And through the Professional Standards Committee, an article is going to come out shortly in the next couple weeks related to how to estimate the sick leave portion of the new compensated absences calculation. So I just want to, and I'm just going to kind of explain this verbally because I wasn't going to bring it up. The article is going to kind of go through how we've been doing it for clients that we're in the process of implementing GASB 101 for. That's in the consulting arm of LSL. We're doing a number of implementations for clients across the country, really. And the steps that we've been taking are really pulling that historical data out of your payroll system. Some of you are using systems like ADP. I will tell you, we have found ADP quite challenging. So if you are having those issues, I know Noah's on this webinar as he's viewing it right now. Noah's been working through that with our consulting team to figure out the best ways. So we'll likely have some answers for you of what to request from ADP, maybe by next week. So pull that historical data. I would start with at least 3 years and see what that usage has been for your employee groups over those years. Then you're going to look at evaluating what's more likely than not going to be used. So if an employee has 100 sick leave hours at the end of the year, based on the historical data, the 3-year look back for that employee, how much are they likely to use of that 100 hours? And then you're going to use that to calculate what the liability is. So, if it's 60% every year they've been using, and it's going to fluctuate. It could be, hey, they have school-aged kids and now they have to stay home with the kids. Maybe a family member was sick and they were using excessive sick leave in 1 year and you have an outlier. You're not going to find it cookie cutter. You're going to do the best you can to estimate it based on the information that you have available. And you're basically going to come up with that percentage and then multiply it by the total sick leave at the end of the fiscal year. It's all based on the accrued balances at your fiscal year end, whatever year end you are. And this is probably one of the more complex pieces that folks have been trying to figure out a best approach. So when this article comes out, look for it. If you're a CSMFO member, you'll likely get the email from CSMFO. If you're not a CSMFO member, you can find it on their website, but we'll also, through our LinkedIn page and our social media here at LSL, we'll make sure we repost it so that you guys can all find it. The other piece for GASB 101, we have been recommending, and we're doing this as a part of implementation, we've been recommending writing we call it a position statement in the public accounting world, in the auditing world. And it's really just a memo to file that documents what your assumptions were, what some of those management decisions were when you took the approach of implementing the GASB. It's a way to communicate your interpretation to your auditors and help document more from a policy perspective what approach you're going to be taking. For the clients that we're implementing on their behalf, we're drafting that memo for them and working with management to help walk them through that decision-making process. It doesn't have to be super formal. You can use Copilot or ChatGPT to help you write it. But it's a great way to just give it to your auditors, and here's the decisions that we had to make along the way. So I wanted to add that for 101 here because that's kind of a more recent conversation we've been having. All right. Jayme, you want to really kick it off with the presentations with GASB 102?
Absolutely, I'll be happy to. Thank you very much, Kelly. And like Kelly mentioned, I would highly recommend that GASB 101 webinar that was linked. They did a great job, and it helps put me to sleep every time I watch it. So if you just one of those people who can't stand but to get enough of compensated absences, you could put it on repeat and it'll be great for you. All right, so if we go on to the next slide, like Kelly mentioned, I'm going to be talking about certain risk disclosures with GASB 102. The implementation date for GASB 102 is fiscal years beginning after June 15th, 2024. So for most entities, that's going to be fiscal year 2025. And the objective of this GASB was to provide financial statement users with information about risks related to government vulnerabilities due to certain concentrations or constraints. Go on to the next slide. In GASB 102, they define what they mean by a concentration and a constraint. And they say that a concentration occurs when you have a lack of diversity related to an aspect of a significant inflow or outflow of resources. And the examples they give are, major employers in your area, major industries, major supplies of materials or services, collective bargaining agreements with your workforce, things like that. And the example they give of a constraint is a limitation that is imposed by an external party or formal action of a government's highest level of decision-making authority. And that might be mandated spending by a higher level government entity, or limitations by your council on raising revenue, or limitations on more issuance of debt, or limitations on levels of spending, things like that. Next slide, please. Disclosures in the notes to financial statements should be made if all of the following conditions are met. First, the concentration or constraint is known to the government prior to the issuance of the financials. The concentration or the constraint makes the reporting unit vulnerable to risk of a substantial impact. And the events associated with the concentration or constraint have occurred, begin to occur, or are more than likely than not to begin to occur within 12 months of the financial statement issuance date. So what they're really saying is, and it's important to note that it's before the issuance. So if you're issuing your statements, I don't know, let's say you're issuing your fiscal year 2025 statements, and it's June of 2026, you're a year behind. Well, and a lot can happen in that time. If you've discovered something that's happened that falls under the definition of a concentration or a constraint under GASB 102, and you need to disclose that through the date of your issuance, not through the date of the fiscal year end. Next slide, please. For each concentration or constraint disclosure, you should describe the concentration or the constraint and what it is, each event associated that could cause substantial impact to the financial statements, and the actions your government has taken prior to the issuance of the financial statements to mitigate the risk. So they in the GASB, they give a few examples. One example they give is, a city owns an airport, and the major airline that goes through that airport has suddenly decided, or has let the city know that it's not a profitable relationship for them anymore, and they've decided that they're going to break their lease and they're going to leave. Well, that would be a concentration issue that's going to affect that city moving forward, and that needs to be disclosed in the financial statements, and anything the city might do to mitigate that issue would also need to be disclosed. And we'll kick it back over to Kelly now for GASB 103.
Just realized I was muted. Sorry about that. There's a question in the chat asking whether or not the One Big Beautiful Bill Act, that's a mouthful, is something that would need to be disclosed under GASB 102. That bill has a whole lot of impacts globally, not just for local governments, but for everybody in it. I would say that if you're evaluating your organization's impacts as a result of that, and it is something that is significant, it wouldn't hurt to disclose it. That's definitely a conversation with your auditors. Anything that we disclose in the financials should be material enough for it to be important to the readers of the financial statements. And especially with that GASB 102, it should be impactful enough that we expect there to be a material impact on the financials in future years, right? Like, or if something happens, if that, whatever that risk is, if it comes to fruition, we expect a material impact on the organization. So that's just a little bit of insight into that one. All right, GASB 103. Everyone's sitting on the edge of their seat. I know we've done webinars on 103 before. Let's launch that polling question. Thank you. GASB 103 was supposed to be overall changes to the reporting model. And when I say overall changes, boy, do I mean reporting changes. It was initially intended to be actually very similar to GASB 34. For those of you who were around back in the day in the early 2000s. It is effective for our June 30 clients. It is effective for next year. I don't think it's effective this year for anybody other than the 1231s. The objective really is to improve and enhance the financial reporting model. I will go one step further to say, I think the real ultimate goal of this GASB was to create consistency amongst organizations, so that if I have an ACFR here and I'm looking at certain schedules and I have another organization here and I'm looking at that same schedule, it's an apples to apples. In my opinion, that's really the biggest thing that they're accomplishing with this. There are 5 major changes. Management's discussion and analysis. It redefines unusual or infrequent items. How we present the proprietary fund statements, the major component unit information in the financials. This is really focused on your discretely presented, and then budgetary comparison information. If y'all haven't answered that polling question, go ahead and finish it up. On this one, I kind of do want to see what those results are. Let's see. So the question was, how far into implementing? Do I have it closed? Did we post the results?
Yeah,
think I can.
they share it right now.
I don't think I can see it. Must be a me problem. Will you read the results, Rachel?
Sure. So we are early implementing GASB 103 was 15 people or 5%. Aware of the basic concepts was 60%. Not familiar at all. We're still recovering from GASB 87 and 96 was 36%.
I don't blame you on those 36. Thank you, Rachel. So for those of you who were early implementing, phenomenal. This is actually a pretty easy one to early implement, especially early implementing certain components of it. For those of you who are still learning, I am doing another webinar in the beginning of October for CSMFO that is specifically focused on GASB 103. So you may want to pay attention for that. It'll go much more in depth than we will on this one. But for the next few minutes, we're going to go through the 5 big changes. So you'll learn a lot about it here. All right. The first one, the management's discussion and analysis changes. It really focuses on telling the story. What is the overview, not just of the financial position of the organization, but what happened during the year? We're used to the MD&A, comparing current year and prior year, and we'll have sentences in the MD&A like, the current year net position was 50 million, which is an increase of $1 million or X% from the prior year. And we've been getting in this habit of just replacing and updating the numbers and not really providing context. So a big piece of this is really wanting that context and that story around what happened to cause the changes. It is requiring these different sections. We should already have the significant capital assets and significant long-term debt. And then we're really supposed to be focusing on known facts, decisions, and conditions. In that overview, they want you to discuss the reporting relationships of all of the statements. I have reviewed hundreds and hundreds of ACFRs over the years, all in some of them were in a pre-GASB 34, but most of them were in a post-GASB 34 environment. And I will tell you, not everyone really discusses this and helps the reader understand why your governmental fund financials are important, but why your government-wide financials are important and how they relate to one another. It also doesn't do a whole, we tend to get in the super technical of modified versus full accrual with the proprietary statements, but really try to focus on your readers and help explain what that means. And how those are different and what we focus on when we're managing a local government. This is one of the examples that's in the statement itself, kind of goes through what we just spoke about the different statements and types of assets and liabilities. I mentioned the detailed analysis and telling the story. Why did it change? Not just that it increased by $1 million, but why did it increase? Focus on the big stuff. Focus on the things that your readers are gonna want to hear about. Maybe there's a large capital project that's happening in the organization that, rather than just referencing it by name, maybe even talk a little bit about what the project is doing from a community perspective and what kinds of, constructing a new building, developing a new park. Your readers tend to be your community. They tend to be your investors. Some of us forget we have a ton of investors who buy our bonds. And we want to paint the picture that we are a financially sound organization and we have a phenomenal finance team who's writing this MD&A to tell the story to our investors. And then I'll be honest, put my finance director hat on for a minute. I want to show my city manager and my city council what an awesome job we're doing, how great the team is doing, and all the good work all of the departments are doing. So telling that story helps us to convey that, but we also don't want to be repetitive in explaining things that are happening in MD&A, but it's also in the transmittal letter, and then it's also a part of our footnote disclosures, all of that fun stuff. This is just a little bit of information between the two, government-wide and fund level. I just wanted to give this to you so that you can see the types of information that you're going to include. Market conditions that may have impacted. If you had a huge GASB 31 swing, it's important to explain that, but give some context. Don't just say a mark to market. Talk about the fact that if it's an increase, that increase is a temporary increase and, won't be realized unless the investments are sold early, whatever the context might be. There's internal changes that you guys have made. Sometimes we have changes maybe we close out funds. Maybe you've got a pretty large increase in your general fund because you've closed out a number of inactive funds. Talk about that. That's important to your readers because that's a one-time increase. Our significant capital assets and long-term debt. You guys know what this looks like. Construction in progress is usually our biggest, other than infrastructure. That's where we see most of our change. Talk about the long-term debt, where new long-term debt's issued, was there a new GASB that impacted, maybe you have some additional disclosures for risks, and maybe it's because of a certain debt that's coming on board. Include that in your MD&A to tell your readers. Oh, there's a good one. That third bullet on long-term debt, changes in your credit rating. I see some really good posts. Some of them I see on LinkedIn. Some of them I just follow news about your organizations, especially if you're a client of mine, about, really, really celebrating the credit rating when you guys have that evaluation done. Put that in your MD&A. That's a great thing to tell the users of your financials that you have a financially sound city or local government. Again, currently known facts, decisions, and conditions. You guys are the only ones that are going to know this. Your community might know this too, but this is probably the number one area where you can provide color and context to those numbers. Talk about what's happening in the organization. A good place to start, if maybe you're new to the organization, maybe you're a newer finance director and you've only been there for a couple months, a great place to start is your budget document. When the city went through or your local government went through and developed that budget, usually we have a lot of commentary in the budget talking about what we're going to do for the year. That's a great place, especially that budget message. It's a great place to start. We're missing something. And we're missing the slide there, but that's okay. Okay, let's move into the unusual or infrequent items. We used to have extraordinary and special, right? Problem is, we didn't really have any guidance on what qualified us as extraordinary and what qualified us as special. And so it was really up to management of whether or not an item would rise to extraordinary, which is the highest level. And it matters because it impacts how we disclose it in the financial statements. Well, now with GASB 103, they're giving us just look, it's unusual. We're going to call it out. It's one bucket of unusual and infrequent items. It is required to be presented separately. So let me take a step back for just a second. The most common unusual or infrequent items that I've seen have been maybe you're separating off a segment of the organization into a totally separate legal entity. So you're literally carving out a piece of the organization and removing it from your reporting entity. That would certainly be unusual and infrequent. I've seen that a few times, believe it or not. During redevelopment dissolution, those were all extraordinary back then, because it just didn't happen. It was the first time ever that had happened. Sometimes it's a separate agreement. I had this with an airport client of mine where they had a lease agreement. Now that's kind of what airports do, are leasing. But they had, it was the dollar value and type of lease that it was that made it unusual. And I got to tell you, that conversation with that CFO about it rising to extraordinary versus special, I didn't think it rose to extraordinary. He thought it did. At the end of the day, I didn't really care because it all kind of gets reported pretty similarly. GASB's fixing that for us. It's just one line item now. But if we have two in 1 year, we have redevelopment dissolution and we have that contract, that lease agreement. You can see here in the example, they are reported separately with a basic description of what that item is. So we would put, gain on or proceed, depending on which statement this is in, proceeds from dissolution of redevelopment, or gain on dissolution, or loss, usually a loss on dissolution of redevelopment. We would put in lease revenue. We would put exactly the description of what that is. And then notice there's a subheader there. It's below other financing sources and uses in your income statement as unusual or infrequent items. This is actually kind of nice. It's very uncommon to have these, but it's kind of nice from an auditor perspective because we don't have to worry about the evaluation of the two different categories. All right, the third major change. How am I doing on time? We're doing good. Third major change is proprietary fund statements. This is one for my my utility district folks who are very particular about your income statement, you may not like the news I'm about to deliver to you. For my city folks, my county folks, this tends to not be as big of an issue because the focus on net income isn't as heavy. The biggest change is we are explicitly distinguishing what goes into operating and non-operating revenues and expenses. So basically the GASB says these 5 items listed, the bullet points under non-operating: subsidies received and provided, contributions to permanent and term endowments, which are very unusual in proprietary funds, revenues and expenses related to financing. That's common if we have debt. If you know what that gains and losses on issuance of debt, the amortization of discounts and premiums, all of that goes under that section. Resources from the disposal of capital assets and inventory, so that's your gain loss on sale. And investment income and expenses. So your GASB 31, your investment income, all of these items, 5 areas, are in non-operating revenues and expenses. Here's the part my utility district folks aren't going to like. If it does not fall into one of those 5 categories, come hell or high water, you cannot put it in non-operating revenues and expenses. It must be operating. Now that's going to make a big difference because some folks, especially on the expense side, have historically put expenses into non-operating so that your operating income or loss, and I don't think the intention was to inflate it, but it's higher because there's expenses down in non-operating. Now they're requiring us to move it up to operating revenues and expenses. So my recommendation here is to go through not just on your financial statements, how you're categorizing things, but go into your GL. This is what your auditors are going to do. They're going to look at what GL accounts you're putting into operating versus non-operating. And they're going to determine whether or not it falls into one of those 5 categories. And if it doesn't, they're going to tell you it's got to move up into operating. I would just do this on the front end. And maybe if you are in a utility district that tends to really focus on operating income and loss, start messaging this to your GM, to your board, that these are calculations that are required to change as a part of the GASB pronouncement. And we will be looking for some changes in the ACFR for next year. All right. The other thing related to proprietary funds that they focus on is this definition of subsidies. This is just a transfer in and a transfer out. We just got to give it a real technical term. They do allow you to put subsidies in both operating or non-operating. However, if it's under operating, it needs to be in the ordinary course of business. This is a snip from the GASB itself. You can see here you have operating income and loss, and then here you have non-capital subsidies. So if this is actually common outside of California. I have a pretty large Texas client, and the public utilities in other states aren't as regulated from a fee perspective as California is. So it's actually quite common for the utility funds to subsidize the general fund operations. So if it is a regular recurring theme that the water fund provides money to the general fund, that would qualify under your non-capital subsidies under operating because it's an every year, budgeted regular recurring transfer. If it's a one-time capital contribution, if it's a little bit more infrequent, then it would go under non-operating. All right. I want to make sure we have time for Jayme. 4th area, major component units. I don't know that there's a whole lot of folks on this call that have discretely presented component units. So I'm going to breeze through this part. I'm missing this. Man, I feel like I didn't give y'all all of my slides for this, maybe because of the time limit. In your major component units, there is your statement that shows on the far right-hand side, it shows discretely presented component units as a single column. The GASB now allows you to show major component units separately in a combining statement. There are some great examples in the back of the GASB that show you that representation of it. Take a look at that if you have discretely presented component units. If you don't, ignore it. The last change with GASB 103 relates to the budgetary comparison information. If you think about your budgetary schedules, currently it's probably a 50-50 shot that it's an income statement format where it shows revenues, expenses, net income, and then it has beginning equity and ending equity. The other 50% are on a budgetary basis. It starts with beginning fund balance, revenues, expenses, and so forth to ending fund balance. They're now telling us it has to be in a very specific format so that, again, when you compare two ACFRs, it's apples to apples, the same statements. They're also requiring if you have your major funds budgetary schedules in the beginning behind your major fund statements before your footnotes, it's required to be RSI now. So take a look at the placement of where your budgetary schedules are for your major funds. You're also now, that very last bullet point, you are also required to include significant variances in your notes to RSI. And that's your required supplementary information section of your ACFRs. So I would expect, for instance, for Jayme, he's going to reach out to you and say, here's your major variances on your budget schedules. We need notes to put into the notes to RSI explaining why these variances existed. So it's just a little bit more legwork. In the statistical section, yeah, we'll skip over that part just because for time. It was just a little baby bullet. Jayme, you're up, 104.
Right on, right on. Before, I don't know if you wanted to get into it, but before we move on to 104, there are a few questions about 103, if you maybe want to touch on those real quick, or...
Sure. There is a question on the capital contributions, for example, a system capacity charge. If we're talking about the type of capacity charge that I'm thinking of, where it's on your utility bills and you're charging your customers every month or every other month, depending on your frequency, I would consider that it's probably going to fall under operating because it doesn't, by definition, it's not falling under the other five. So I would definitely take a look. Sometimes the capacity charges are different. Again, it also depends on where you're located. Some organizations charge a capacity charge at the connection point. So, in a rural area, you may have a large $2,000 fee when that line is connected into this system. If it's that kind of charge, it might be different. But generally, I would say it would probably be under operating for that. For wastewater utility special district, we collect capacity fees for new customers that connect to our system. That still qualifies as non-operating. See again, same, that's kind of a similar question to the one above. Again, asking again about the capacity fees. It's not really explicitly falling into those 5 buckets. What I can do is I can go back into the questions and answers, see if there's been a question in the implementation guides to see if that specific question has been asked. And that way, emphatically. So for those of you who are asking specifically about capacity charges, reach out to me separately And if I can't get a direct answer out of the GASB, I can actually pose the question to GASB directly and ask on your behalf. Property tax revenue, certainly operating. For property taxes, you're a water agency. I'm wondering if this is more of a sewer property tax, because I don't know water is usually a volumetric, not a flat rate property tax. But if you're getting it and it is funding the operations of your water fund, it should be operating. Developer fees. I don't even know if everybody can see these questions. I'm just reading it. So it's asking about whether or not a developer fee related to the buy-in into the existing infrastructure. Depending on the frequency, honest, and depending on the dollar value, I may even consider that a special item. It just depends on, is this a big development? Like maybe you're in an area that has an undeveloped area around you and they're annexing into your organization. And now you're adding, you had 30,000 customers and now you're going to have 40,000 customers. I mean, there's a conversation there for sure. If this is in the ordinary course of business, it would probably be similar to those capacity fees where we would want to double check that. Rental income. If it's rental income, like there's a lot of questions. If it's rental income like a lease tower or a cell tower, to me, that would probably be under non-operating because it's not it's an ancillary to operating the water utility. I'd probably need to know what specifically that was. If it's rental income if you are a water agency and you're leasing out a part of your building, I could probably make the case that that's operating. But it really depends on what you're renting out.
If you'd like, Kelly, I can
Go
start.
ahead and I'll answer these in the chat. Yeah, that way you can go.
All right, so we're going to move on to GASB 104, which is disclosure of certain capital assets. If you could switch over to the next slide, please. Yes. And really, we got a polling question first. Sorry. Before today, how familiar were you with GASB 104? Well, I just started reading about it today myself, so that's
funny guy. Funny guy.
All right. So while y'all are answering that, I'll just I'll keep going. If you can go to the next slide. So GASB 104 is going to be effective for fiscal years beginning after June 15th, 2025. So for most entities, that's going to be fiscal year 26. And it establishes requirements for certain types of capital assets to be disclosed separately in the capital assets note disclosures required by Statement 34. And really, so this is more of like a clarifying GASB. It deals with a few different things. Kelly, could you go to the next slide, please?
Yes.
And one more, I'm sorry. So really, they're kind of clarifying how they want lease assets, intangible right to use assets under the public-private partnership and public-public partnerships for the operator under GASB 94, subscription assets, and then intangible assets. And what they want is for lease assets and the operator assets for GASB 94, they want those to be reported by the major class of the asset. They want subscription assets to just be disclosed as subscription assets. And intangible assets, they want you to disclose by the major class of assets. So maybe software might be your intangible asset that you created, something like that. If we could go on to the next slide. And here is an example that this is the example GASB gave actually in GASB 104. And what they're doing here is in some cases, and I know even I'm also guilty of this sometimes, like we would just say we would have lease assets on the footnote disclosure, and we wouldn't spread it out by buildings, equipment, things like that. They're saying, no, we want you to have those split out, as you could see here on this example. and it wasn't really clearly stated that way originally, but that I believe that was the intent. Just they didn't clearly state that, so that's why they're coming out with GASB 104 and saying to everybody, this is how we want this to be done. You can also see here they have subscription assets, laid out as subscription assets. You can see the intangible software there, and so this is kind of moving forward how they want these assets to be disclosed in the footnotes. If we can move forward. See. Additionally, GASB 104 changes up some things about how we disclose capital assets held for sale. Specifically, it's said that a capital asset is classified as held for sale if the government has decided to pursue the sale of the asset, and that it is probable that the sale will be finalized within 1 year of the financial statement date. So no longer carrying an asset held for sale for years and years, and it's never getting sold. You need to be pretty sure that it's going to sell within the next year if you're going to list it as a capital asset held for sale. And the factors to consider when determining probability of sale is, whether that asset is available for immediate sale in the present condition. So you don't have to do a lot of work to it; it's ready to be sold today. And by that, they mean ready to be sold, and someone would actually buy it in that condition. Whether an active program to locate a buyer has been initiated, which may include the asset being put out for bid. So you're actively already trying to sell the asset. Market conditions for selling that type of asset are in such a way that you actually could sell that asset. Like if you have it listed for sale, but nobody's going to buy that, that's not really, you can dream all you want, but that's not going to happen. We're not going to disclose it as an asset held for sale. And you have all the necessary regulatory approvals needed to sell that asset. So if it was something purchased with grant funds, you've gotten the appropriate approvals to sell that object that was purchased with grant funds. There's no requirements that you need to hold on to it or any other kind of regulations that might exist. And you should evaluate that annually. So if you've previously, disclosed an asset is held for sale, you should look back at that asset, make sure it did sell, that maybe those conditions are still being met, and that it should still be carried for sale. Maybe it didn't get sold within that year and you thought it would, but you're nearing the end of it and it looks like it's about to sell. Okay, well then that makes sense. You might want to keep carrying that as an asset held for sale. If we can move on to the next slide, please. And now for capital asset held for sale reporting, you would report that asset within the major class of assets. So if you have a building held for sale, it would be reported in your footnote disclosure as a building. But then in the notes, you would need additional disclosures detailing, the historical cost of that asset, like what it was purchased for, the amount of depreciation of that asset, date, and any debt that might be related to the purchase of that asset, or any debt that the asset is held for sale and is pledged for as a collateral. We can move on to the next slide, please. Here's the example disclosure that GASB gave in GASB 104 for a capital asset held for sale. And in this one, they just said that, included in the capital assets in our buildings footnote disclosure are capital assets that are held for sale. Those buildings are reported in governmental activities. They have a historical cost of $8 million and an accumulated depreciation of $5 million, and they are pledged as collateral for debt with a balance of $1.5 million. So this is where you would disclose that there's an asset held for sale. It would be in the footnote as part of your capital asset footnote underneath your table. Could I move to the next slide, please? Oh, and that's it. So now we're moving on to the current GASB projects.
All right.
I'll kick it back to Kelly.
Thank you, Jayme. For those of you who have questions in there, I'll go through and answer those separately, and then make sure we get back to you on that. For the current GASB projects, there's quite a heavy lift that they have going on right now. They're looking back into going concern issues, and really focusing, if you think back the last probably 10 years, we had a few organizations in California anyway, that were in significant financial distress. So they're looking closer at that. It's early stages, just in the comment period. I can't see the date there, but I know that period ends. Oh, it just ended. So they'll move on to the next phase of that project soon. Infrastructure assets, I think, are a big one that we're going to want to pay close attention to. For those of you who have not worked for numerous organizations, when GASB 34 was implemented, there were a couple of different options that were allowed for reporting infrastructure assets, including a modified approach to valuing assets. The biggest challenge, infrastructure assets, in my opinion, artificially inflate our balance sheet because you cannot dig up a pipe in the ground or crumble up a street and cash it in for, to be able to satisfy debts. So if we think about the financial solvency of an organization, and when we go back and we look at financial stresses on an organization, you're not going to liquidate your infrastructure to be able to help with your finances. So they're evaluating whether or not our current reporting model for infrastructure is the best reporting model and whether or not that needs to be changed. Revenue and expense recognition, both of these, by the way, I think came out of 103 and they just separated them out. The revenue and expense recognition goes right back to modified versus full accrual. It goes right back to some of the differences between the budgetary basis that we do in our governmental funds and running our proprietary funds and internal service funds like a real business. Those are both an exposure draft. Those are ones that I would anticipate us having some pretty good impacts in the future. And then subsequent events doesn't look like it's a huge impact. It's really just more the assessment of it. We'll bring that information as soon as that gets issued, but I think that might be the next one coming out. So a couple of big ones that are in exposure draft that we got to keep an eye on, and we'll certainly bring that information to you as it gets released. So I'm only 2 minutes over on our timeline. Let's get back to some of these questions and answers. Actually, before I do that, polling question. Who does your agency task with facilitating GASB pronouncement implementations? Is it your finance department, internal folks? Do you look to your auditors for help, or do you look to other folks, maybe third-party consultants? Maybe it's even our consulting department instead of our auditing department. And while that polling question is happening, we do have another Back to Basics webinar happening October 1st, related to investments. Heather's going to be doing that one. You can register when the email comes out, you can register there for that webinar. And you can always check our website as well. We always keep all of our webinars up to date there. All right, let's get back to these questions. I was just getting ready to answer a couple. Somebody asked if we have the names of agencies who have early adopted 103, and specifically curious those proprietary fund statements and the budgetary schedules. One thing that I want to point out, GASB 103, go to www.gasb.org, click on pronouncements, and you have to click an accept button, but you go to GASB 103. If you scroll all the way to the back of GASB 103, there are beautiful examples in that GASB. Some of the snips that I think we shortened this because of the time frame, but some of the examples that I have in my longer deck that if you do the CSMFO webinar, you'll see those. It has those examples straight out of the GASB. They're at your fingertips. You can Google it right now. And get those examples. That's your best bet, Chris, is go straight into those examples there. Let's see. Another question on the budgetary schedules. Do you advise that we do the same for capital projects and other funds that are not general fund and not special revenue fund? Very interesting question. And a lot of non-auditor folks don't know this, but we only include general fund and major special revenue funds as RSI. I've actually, over the 20 plus years, I've had clients ask me, well, how do you determine which ones go in this section and which ones go back here? it's a weird calculation that we have to go through that's literally defined in GASB 34. Actually, it's probably pre-GASB 34 now that I think about that. But yes, the answer is yes. Every single budgetary schedule should be consistent throughout the entirety of the document, whether it's RSI or supplementary information. So when you change the format, if you prepare your own ACFR, get on that early and change the format across the board for all budgetary schedules. Good question. Polling question answered. 70% of you do it in-house, 20% rely on your auditors, and 10% rely on outside help. That's pretty consistent. I know during COVID, and then also when we have big GASB pronouncements that come into effect, a lot of times folks will reach out and see if, like leases and subscriptions. That's a heavy lift for a lot of organizations, and your teams just didn't have capacity. I feel like it's those ones that we tend to reach out outside of the organization for assistance. The enterprise, so there's a question, are the components of 103 that don't pertain to enterprise funds, budgetary info and RSI example, those are your governmental funds. It's all budgetary schedules that it applies to. The enterprise funds piece is really the statement of revenues, expenses, and changes in net position. And then the budgetary piece, I think that was number 4. Number 5 was the RSI part, the budgetary schedule. So it applies to everything. What would the appropriate category for asset held for resale if it can't be sold within 1 year? Well, that's a balance sheet. So what would be the appropriate category for an asset held for resale that can't be sold within 1 year? At the end of the day, there's an intention behind it. This is an anonymous attendee, so I don't know who it was, but if you're as old school as I am, back in the redevelopment days, land held for resale was never sold in 1 year. It was always more than 1 year. In fact, all of the redevelopment agency funds used to be capital project and debt service funds. So it would still be an asset on your balance sheet that qualifies at the fund level, not gov-wide. It does not qualify as a capital asset. If you are not using it to operate your local government, if you are not physically occupying that asset or leasing it out to a third party, then it's not an inventory type item. Which is what assets held for resale typically it's either viewed as more of an inventory or an investment. And investments are recorded on the balance sheet of your fund level statements. And I'm gonna keep going through these. I know we have a couple more minutes, but I'll stay on to answer them all. Changes in joint venture. That's probably going to be I need to look it up question. Question is, what about changes in a joint venture? I'm guessing this pertains to proprietary funds and whether or not it's operating versus non-operating. I can probably get around it being investment income or expense. It depends on what that joint venture was for and whether or not we're materially participating in that joint venture. And whether or not that joint venture pertains to our ordinary business. Usually, if it's sitting in a proprietary fund, I'm assuming you're a public utility, not like a city or a county. But you may want to message me separately, and we'll see if we can help you research that one, because that might be I got 5 questions to ask before I can really give you an answer. We talked a little bit about the capital contributions and the developer piece of it. Typically shown. Switch your idea. We talked a little bit about the contributions from developers. Okay, I think this is in response to that property tax question where I had said, I'm assuming it's based on it was the property taxes, are they operating or non-operating? And I said, I assume it's a sewer or wastewater. It is water, but it's flat rate passed by the county. That's operating. 100% operating. All right, our wastewater utility began selling by product reuse to a private company. We typically have reported this as non-operating, being that it wasn't the key service being provided. You sound like a wholesaler. Just because you were ordinarily retail doesn't mean you're not retail and wholesale now. And you're still in your primary, I'd say it's operating. Just on the surface. San Diego County Water Authority is I haven't worked on them in a lot of years, but they're a water wholesaler in Southern California. And they have a lot of participating agencies who are both wholesale and retail. And those are always both operating. Did I get them all? I know I was just kind of scrolling through. Jayme, are you seeing any that we didn't answer?
No, I think you got them.
Okay. All
Yeah.
right. Look at that. 11 on the dot.
We did good.
Well, thank you very much, everybody. We know we kind of breezed through this. As I mentioned, we've got more webinars coming. Keep an eye out for those. I have two CSMFO webinars coming up. One of them is on GASB 103. And that's going to be a specialty topic. So it's going to have a smaller attendance pool. So if you're interested, sign up right away. The other one, I believe, is on subscriptions. And it's a refresher for GASB 96. So keep an eye out for those coming out through CSMFO. Keep an eye out for that article. And then always keep an eye out for our newsletters and for upcoming webinars through LSL. We appreciate all of y'all attending. Have a great day.
Thank you, Jayme and
Thanks,
Kelly.
Jayme.
Just a reminder, you will receive the slides and the recording later today. So be on the lookout for that. Everybody have a great day.
Thanks, everyone.